get there because this gets to the point, and we've kind of been through various market cycles where we've had one or maybe a small handful of stocks that really just have dominated everything. They are kind of like the vortex for the entire world. And NVIDIA, and I guess you can maybe broaden out to chips overall, that is the trade right now, isn't it?
It sure is right now. Yeah.
Does anything change that?
Well, the thing that, what I would point out is over the last 100 years, there have been market leaders, and it's usually a narrow set. So what changes the AI? I mean, we are seeing, if you look at the equal weighted S&P, it's gathering more strength. So we are seeing a broadening of the recent rally, and I think that that would be a healthy thing to see continue.
When we talk about, and you make a good point, I mean, we've been through this before. It was Apple. In the old days, it was GE and the telecoms. We've always had this sort of a churn that goes through. But it always raises the question that if you were not lucky enough to sort of get on this train right when it left the station, do you try to get on it now?
I wouldn't get on that narrow set right now with the amount of enthusiasm and the PEs priced into that sector.
It just looks too rich for you?
It's a bit, yeah.
But it winds up moving, if what Charlie McGilligot said was true, right, it's central bank power and it really has the power to move the markets, then it's hard to ignore, right? Is it just sort of like the broader indices is what you want to own, or you want to fight against it like you wouldn't want to fight against central bankers?
No, well, we would want to own the broader indices and just keep our humility and let the winners win. But we think that the bigger picture is going to be dominated by the economic cycle and these other drivers and not a few companies.
So central banks still matter. Okay,
they do matter.
Tell Charlie that. Within equities, you guys still remain underweight, right? So what's your signal to buy?
So we've been underweight equities and overweight fixed income. Fixed income has been a smoother move, frankly, and it's also rallied with yields coming down, pricing ahead of this easing cycle that's very likely to start in a week. We've seen the amount of, you showed the intraday volatility on the equity side, but also the August dip. We think that highlights some fragility in the markets. What would cause us to get back our exposure? Probably if fixed income got too dear, too rich, that would be one thing. Another, repricing in equities, a substantial repricing. A third bit would be if we get greater confidence that a soft landing is possible, which I think is the Fed's baseline right now, and it's probably the equity market's baseline. But we think it's a pretty high challenge to land that plane so carefully, coming from a 5.5% funds rate.
Where do you think, though, what the Fed can do? Because we've gotten to this point now where everyone sort of knows this easing cycle is coming.
Yeah.
There's still a lot of disagreement as to exactly how aggressive or how expansive that cycle is going to be. Remember, this was a market that really did think we were going to get 75, 100 basis points of cuts this year alone. They've really pared back some of those bets now. I know 25 is the basis that we're going to start with. Is that
for
your
next
case?
week? Yeah,
for next
I mean,
week.
I think, if gun to my head, I would say that.
Yeah.
But look, we have 100 priced in for this calendar year, 4 cuts, and 10 cuts priced in through the end of next year. And I think that leaves a good amount of variability. That's the average kind of cut. So, or the average what's priced in the market. But look, you could see a weakening economy where on the way up, the Fed hiked aggressively. We could see if things were to weaken, them ease aggressively.
But I'm curious about when we look at the number of cuts priced in, and I'm glad you went out to 2025, because this gets into the soft landing scenario. If you're talking about bringing the Fed funds rates down from whatever 5.25 on the low end, down to, I guess, based on the number of cuts you're talking about, that would take us to round 3 or less. Is that a soft landing? I mean, if the Fed feels compelled to take us down to 3, I would think that there's got to be some weakness there in the economy somewhere.
Well, we are coming from a very overheated employment picture and a ridiculous, inflation picture. The inflation picture is so well behaved now. On the employment side, we've softened. We're not in negative territory, but we're back to the pre-COVID levels. So to get us to 3%, yes, some weakening from here, but also the Fed knows they're restrictive right now. So I would say that the actual path that we see the speed with which the Fed moves will be dictated by when and how that weakness develops.
You had mentioned sort of when yields get too overheated, then maybe you'll reallocate some money from bonds into the equity market. What yield is that?
Well, right now at around 370 in 10 years, we just don't think that's very exciting at all. I mean, that's pricing in this kind of midpoint. Look, if funds were, I think we have a higher degree of odds on a recession than the market. And that justifies lower yields than, say, the market. But if you got a perfectly soft landing and Fed funds were down at 3%, then probably 10s could be a little bit low. On the equity side, it's all a relative play for us. So we had this strong conviction. We thought the bonds were going to perform in a better range of scenarios, so we took money off the equity table to put it there. So we'd have to kind of see how things develop with the data.
How are you guys looking at the election, by the way?
Yeah, so all of our analysis on the election is inconclusive, right? So it really depends the exact composition that you're going to get. We don't think either party is going to have a clean sweep. We think that whatever economy is handed to the incoming president matters more than a lot of the other factors. So we're not really playing for one way or another right now. And the polls show they're so close at this point, so it's not at our forefront.